Hello investors. Have you ever thought to invest in any business or any asset but not sure how to evaluate the real value of that business or asset, or whether to invest in that business will be right decision or not? Then this video is for you. Welcome to Invest Money UE. In this video we are going to talk about very important topic, how to find the intrinsic value of any business and also evaluate whether to invest in that business will be right or not. So let's get started. Warren Buffett, world's richest investor, says you should always purchase any business at the price lower than its intrinsic value, keeping a margin of safety. But if you don't know how to calculate the intrinsic value of any business, then how will you use margin of safety? So successful investors calculate intrinsic value of any business by themselves independently, then compare it with the seller's price, ensuring the market price does not influence their valuation. So let's take a private company as an example, one without listed market price, and calculate its intrinsic value. Let's say there is a bakery named Abu Dhabi Bakery Company, ADBC, which has been around for 10 years, located in a prime spot with many regular customers. The bakery's owner wants to sell it because he wants to retire. You have plenty of money and financial knowledge, so you ask for the last 10 years bakery's financial statements and analyze them carefully at home. After checking income statement and completing quality analysis, finally you concluded that company will continue making a steady annual profit of 100,000 dirhams. At this point, let me give you a crucial piece of advice. Whenever you are investing in any company, evaluate their product's quality, customers' trust in the brand. Meaning, doing proper quality analysis should be the most important part of your analysis. The bakery isn't risky and you have confirmed its quality, so you would be happy with 12% return on investment. Since its customers aren't likely to demand much more in future, this 100,000 profit is directly converted into cash from operating activities. Now let's calculate the business value using simple formula. Take that 100,000 profit and divide it by 0.12, your required rate of return in decimal form. This gives you a business value of 833,000 dirhams. Let me explain the reason behind this calculation. If you buy this business for 833,000 dirhams, the profit you will earn every year will be yours. Since you are expecting 12% return, the business first year profit will be 100,000 dirhams, giving you return you anticipated. This method of valuation is called discounted cash flow method. Essentially, you are discounting the future profits of the company back to their present value. Now, this might sound a bit complex, so let me simplify it further. As we discussed in previous videos that the value of money reduces. For example, 112 dirhams of next year is worth 100 dirhams only today at 12% discount rate. Let's say this bakery will earn 100,000 in profit every year forever. The real value of future profits decreases over time. The first year's profit has a present value of 89,000 dirhams. Second year's profit, though still 100,000, has a present value of 79,000 and so on. The longer you wait for the profits, the lower their present value. That's because while you are paying today, you will only get the profits in the future. After 100 years, even if the bakery still gives you 100,000 in profit, the present value of that money will be worth less than a rupee due to compounded growth over time. So in the long term, the present value of your business decision may not be zero, but it will be very low. Finally, when you add up all the present values of the future cash flows, then guess what will be the value? You will arrive at 833,000 dirhams, which matches the value we calculated using the simple formula. So this exercise highlights a golden rule of valuation. That is, the value of any asset is the sum of present value of all expected future cash flows. Because we are investing money today and expecting a returns in future, we discount these future returns to their present value based on our required rate of returns. Had I just not told this rule at the beginning, many people would not have understood then, but now with this explanation it should be clear. As you were a smart investor, you were already aware of this concept and decided to invest in a company that has shown a year-on-year increase in profit and don't want to run that company more than 10 years. Here, future returns are uneven and you are selling it after 10 years. Then should you invest? Will it be profitable? Will you get expected returns? Let's see. Let's take the same example of ADBC, but change in profit statement. It has shown a growth in profit at the rate 5% CAGR in last 5 years. And last year's profit was approximately 100,000 dirhams. Now you are planning to buy this at 800,000 dirhams, keeping some margin of safety and run it for 10 years. Now let's project the profits over 10 years, assuming initial few years growth will take time to establish with new management and branding. First few years profit growth was only 3%, then it increases to 4% and becomes stagnant in last 3 years. If you see, absolute profit is of 449,000 dirhams, which is approximately 56%, but don't forget that it is spread in span of 10 years. As you already have done the quality analysis and your desired rate of return on this business is 12%. So should you invest or not? To check this, if this company is worth investing or not, we will first calculate its intrinsic value, that is sum of present value of all future cash flows. For that you need net cash flow, that is sum of present value of profits that will come year by year. Then terminal cash flow, that is present value of amount you receive if the business is sold after a certain number of years. If after 10 years you are selling in the same price as you bought the business, then terminal cost is 800k AED. Hence, I took terminal cost multiplier as 1. You can choose according to your analysis or to inflation. Now the present value of these profits can be calculated using Excel PV formula, which is equal to PV desired rate in decimal form, that is 0.12, number of year, like for 2025 it's 1, payment is 0, and future value with minus sign, that is the profit of year 2025. Like this, it can be calculated for all the year and also for the terminal cost. Then intrinsic value or real value will be the sum of all these present values, which will come as 937,000 dirhams. Hence, to decide whether to invest or not, you must calculate net present value. On the basis of net present value, it is decided if a project is worth investing in. Mathematical concept is to sum the cash outflow with minus sign and intrinsic value of the business. That is minus 800,000 cash outflow as it's going out from your account plus 937,000, which is the intrinsic value of the business we calculated, which gave us net present value as positive number. Whenever net present value is positive, you should invest in the project. Means you can invest 800,000 dirhams in this business and you will get the desired annual rate of 12%. If the net present value is negative, it doesn't mean you are losing money, just that you aren't getting the expected returns. We have done these calculations mathematically, but it's easier to do using NPV formula of Excel. So no need to calculate present value of future cash flows separately. Formula will take care of it. In Excel, simply use equals to NPV formula, enter the discount rate, that is 0.12, select all the cash flows including cash outflow with minus sign and future cash flows, and check your result. So you can see for 12% discount rate, net present value is positive. However, if we change this discount rate to 15%, net present value will become negative, meaning the project is not profitable as you aren't getting the expected returns. So that's how you calculate net present value to check if a project is worth investing in. This is just one example, friends. Similarly, you can check intrinsic value before investing in any new project or in property, or even calculate intrinsic value or share of any listed company before investing in it. Concept of intrinsic value and net present value will remain same. Similar to net present value, there is another concept which help you decide whether to invest in that business or not, that is IRR, which we will cover in upcoming videos. That's it, friends. If you like this video, please share it with your family and friends. Don't forget to hit the like and subscribe button. Thank you. Happy investing.